Hey everybody, Chuck Barone. Tuesday, February the 28th, 2023, last day of the month. We're moving into the home stretch of the first quarter. I can't wait to see what March brings, man. February was the craziest month ever. We're learning so much about how our government is so inept, so lame. Even the smallest little thing, they can't handle it. Wait till you hear some of the stuff I got today, guys. Craziness. I can't wait to see what March brings because February was so much different than January was, right? In January, it was all about the pivot. It was about the pause. It was about the market rallying. It was about, wow, everything's going to be hunky-dory, man. Mortgage rates were going down. Everybody was jumping up and down. Yay, this is great, man. We're going to be okay. This inflation thing, we've licked it already. Look at that. Now February rolls around and, well, not a very good month, was it, guys? Just a catastrophe, and the entire mood of the markets and consumers, pretty much investors at least, investor/consumers, darkening, really dark, right? But anyway, we got a lot to talk about today. Before we start, as always, I just want to welcome everybody to the show. Thank you guys for your support. What you guys do every day for us keeps us going here. We appreciate you guys. Markets today. Well, yesterday was not a great day. Today, not a great day either, right? Stock market's down across the board. Not a great day. Chart looking crummy. Not really down big, but down, and just the trend is negative. It was a negative month for stocks. Dow losing 232 points today. That's the big loser. S&P down 12. NASDAQ down 11. The sentiment in the markets is pretty negative, I'll tell you that right now. People starting to pull money out of the markets. I talked about that yesterday. Equity funds bleeding cash. Billions of dollars being withdrawn. And the funny thing is, let's see what the mood is by the end of March, because it could be night and day. That's just the kind of market we're in right now. There's nothing to hang your hat on you can say with certainty. Bond market today basically flat. Nothing happening in bonds today. 10-year 3.92%, no change. 2-year 4.81%, up 2 basis points. So look at that now, the yield narrowing, right? So we have this inversion where the short-term rates are higher than the long-term rates. It's been getting wider and wider now. It's now up to 89 basis points. It's on its way to 100 basis points. I think the all-time high is 114. This is signaling not only a recession, which the inversion at whatever level signals, but when you see it this deep of an inversion, well, that's telling us the recession is going to be not a fun one, right? Not short, not shallow, but long and deep. Fun. Dollar today, up small, 104.98 on the index, threatening this 105 number. Dollar showing strength, guys. It's just, I don't know if it's dollar strength or world currency weaknesses, but the dollar's certainly holding its own. Metals, decent day today, up day today, in spite of a strong dollar. Metals gaining today. Gold up $9.80, 1,828 per ounce. Silver up a quarter, $20.88 per ounce. I think that metals want to rally, guys. I really still believe 2,000 gold, 25 silver, coming soon. Oil today, up day for oil, still in its basic trough though. West Texas Intermediate up $1.14, $76.82 per barrel. It's just been, it was 80 and 85 was the trough. It was just stayed there for about 6 months between those numbers. Broke out, crashed back down. Now it looks like it has a new trough between 75 and 80, and it's just staying right in that trough. Nothing happening. Bitcoin today down small, not a non-event in the market for Bitcoin, down $156, 23,202. Bitcoin holding its value, man. Got to say it what it is. Now, yesterday I neglected to go over the data stuff because there was no real data yesterday. But today we'll be getting some interesting stuff, and for the rest of this week, just to give you guys an idea what to look out for, okay? So today, we haven't seen the reports yet. We're going to get Chicago Purchasing Managers Index, and we're going to get consumer confidence numbers. Both of those are expected to be up. We'll see if they are when we actually get the data. Tomorrow, we'll get some interesting data. We'll get the construction spending numbers. We're going to get the ISM manufacturing index, and we're going to get the mortgage bankers index. Thursday will be our big day. Thursday is the day the data is going to be market moving stuff, really. You're going to get jobless claims, which has been a hot item for the Federal Reserve. Last time around came in at 192,000. They're estimating 197,000 this week. We'll see. Jobs have been coming in hotter than expected consistently. We'll see if they can get a little closer this time. 197 is still a pretty good number for jobs. We're also going to get productivity numbers that day. Productivity expected to be up. We're going to get unit labor costs. This is another one that goes with jobless claims. The Fed's going to be looking at closely. Going to be telling us what's happening with the cost of labor. And we already know the cost of labor is going up, but these are real indicators of what the Fed's going to be looking at and how they're going to take this data to set what they're going to do going forward, right? So the consensus has been they're going to cut it off around 5%. Now the consensus is 5.5%. I saw an article today, Bank of America now expecting over 6% overnight rates. I don't know. That might be a bridge too far, but I can certainly see it going up to 5.5. We got the Federal Open Market meeting coming up soon here, and they're expected to raise a quarter. The market is already pricing in now from a quarter to a half on that bump. We'll see. It's going to be a fascinating month, March is. And Friday, to finish the week, nothing happening on Friday, so we'll kind of put all these numbers together for you guys, wrap the week up, give you guys an indication of what we can look forward to coming up next week as we start the month of March. News you guys need today. Real quick stuff, guys. 6-month Treasury bills today hitting 5.14%. Wow, that's really nice for income investors, especially if you can roll it over every 6 months and get over 5%. I think that's something that's going to be attractive to income investors, seniors, the typical CD buyers, right? This is the highest T-bills the 6-month T-bill has gotten since 2007. The highest since pre-economic catastrophe 2008, right? So I think that with rates going to be continuing to rise, they probably already factoring an increase in March in that T-bill rate, but nice numbers for income people, not such great numbers for debt people. Well, we've been telling you guys from the beginning, this is why this stuff makes sense, guys, right? So if you're saving your money, you're now going to, even if you just leave it in an interest-bearing account, if you shop around a little bit, you're going to be earning money on your savings because rates are up, right? At the same time, if you're in debt, if you owe money on a credit card, you're charging debt, whatever debt you're carrying or collecting, especially new debt, it's getting more expensive. So this is the time to change the mindset. No more debt, no more living beyond your means. Time to get right and start banking some cash, earning some money on the money you're banking, right? 6-month T-bills, 5.14%. Also today, an interesting thing I was reading, corporate stock buybacks this year are expected to exceed $1 trillion. So corporations, our buddies, our overlords, right? Especially if you work in government, the corporations are certainly your overlords. They're going to take $1 trillion that could be productively spent on expanding their factories, new equipment, on giving better benefits to their employees, on taking care of their employees with better wages, safer conditions, research and development to develop new or improved products. $1 trillion. But they're going to take that money and buy back their own shares to the benefit of, allegedly, the shareholders. I would say that, if you own 100 shares and they're buying the stock back, well, how much did you really benefit there, man? Right? Now, it's going to benefit the institutional investors, people who buy shares in the millions, right? It's going to benefit the executives for sure, right? The boss who gets a $6 million salary and stock options for who knows how many shares at below cost, of course. And the funny thing is, when I was a young lad and was just starting to invest, stock buybacks were illegal. You could not do this. It was considered market manipulation. It was considered price manipulation of your stock. So now, not only is it legal, they're going to break the record, $1 trillion in stock buybacks. Well, the rich are going to get richer, aren't they, guys? Moving on. Fed Reserve. Reading an article today. This is not good stuff, guys. The Federal Reserve right now, literally bleeding green, bleeding cash. Fed losses have exceeded $36 billion since last September. So that's 6 months, guys. They're losing $6 billion a year. They said, listen to this, they said they had $42 billion in cash reserves. Well, now you can scratch $36 billion of that off, leaving them with $6 billion in cash reserves. And at the rate they're losing money, the Fed is basically insolvent, guys. As their bond portfolio gets further and further and further and further and further upside down, they're just toast, man. So here's the worst part, though. As bad as that is, the Fed is going to create new debt, and they're going to print money to make up the difference. So basically, right, they're going to create all of this out of thin air. Now, guys, there's a definition. This is a definition of what it's called monetizing the debt. Okay? Monetizing the debt. And when countries have to monetize their own debt, and there's no market of investors to buy that debt, or the amount of debt is so completely, overwhelmingly tidal wave big that investors can't absorb it all, the debt issuers print money, buy their own debt, basically creating a circle jerk, right? And this is a sign of total monetary desperation. So now you're looking at the Fed bleeding cash, upside down, losing $6 billion a month. Over the past years, they've actually been giving the Treasury billions of dollars in excess earnings from this bond portfolio. Now they're losing friggin' billions of dollars. Who do you think pays the tab for that, guys? Newsflash. It's us, the schmuckatellis, man. Middle class, working class. We're the ones who get the tab. So not only do we get the higher prices, not only is it eating into our friggin' equity in our houses and destroying our 401ks, but now we get to bail out the Federal Reserve. Just wonderful, wonderful stuff, man. I mean, I'm just trying to figure out, can somebody point to me one competent person in this whole big picture here? Really? Federal Reserve making a giant mess of things. Janet Yellen, instead of focusing on the debt ceiling and what the hell's going on with the Treasury, she's in the Ukraine. Well, yeah, because it's really important to have the Treasury Secretary over there giving away billions of dollars. And the rest of the players in this monetary fiasco. And then you look at the other side of the ledger, the fiscal stuff, which is the Congress, the White House, the government, and how they spend their money. Not to mention states, everybody just groaning under the weight of colossal debt in the face, and they're going to be rolling this debt over in the face of higher and higher interest rates. Guys, it's just a topsy-turvy, crazy-ass, nutso world. But you've been listening to our advice. Staying with the basics. Not trying to be any razzle-dazzle. And I was reading a quote Warren Buffett said. He said, patient investors like him make all their money from traders who think they know what they're doing in the market. That's paraphrasing. I just thought that was pretty funny because this is basically the stuff we've been advocating, right? Save your money, invest it conservatively. I've given you guys a definition of risk. The definition of risk is probable loss, right? We've been advising you guys to trim down your debt, spending your money wisely, making sure it's okay to spend, just not okay to waste, cautioning against impulse buying and stuff that can be put off that you don't need but want, putting that off, saving that money instead, now earning 5.14%, and not taking on new debt, paying down what you have. These little simple things we've been talking about, this is the foundation of becoming, maybe you're not going to become a multi-millionaire with these strategies, but you're certainly going to become wealthy because you're not going to need all the money you bring in. And that is the ultimate definition of wealth. You're in surplus, right? So anyway, guys, that's it for today. I got to talk a little bit about M2 tomorrow. M2 really dropping, man. The Fed pulling cash out of circulation. Biggest drop in the history of M2 since 1959. We'll get into that tomorrow. I don't want the show to ramble on forever. As always, guys, we appreciate your support. We appreciate all you guys do with your likes, questions, comments, shares, and all you do. We'll be back again tomorrow. We know we got some interesting stuff tomorrow. Be a little bit about housing, so we'll see where that's going. And I was reading some interesting stuff about that. We'll go over it all tomorrow. Until then, guys, take care. Thanks.